You are welcome to another video. So in today's video, we'll be looking at national income equilibrium. Now, before you can understand this very well, we will need to look at the concepts of withdrawals and injection. Now, before moving to withdrawals and injection, there's a need to recall the circular flow of income. That's why you can see on the board the chart of the circular flow of income. And this is for simple economy, that is two-sector model. Now, let me explain. I wrote some terms on the board here, whereby I said when I'm using the term simple economy or two-sector model, it simply means that in that economy we are considering two people, and those are two things rather, and those are households and firms. But when we talk about open economy is also known as the first sector model, whereby we are considering household, firm, government, and foreigners. So this simple economy is also known as closed economy. Know that is also known as closed economy. But the circular flow of income that you are seeing on the board is for two sector model, which is the simple economy. So we are only looking at the household and firms. So now when you look at this circular flow of income, you can see that above we have the factor service. That is, the household provide productive service to the firms, and the firm pay the household for their productive service, which is known as the factor income. And this is calculated by using the income method for calculating GDP. Do you still remember that method of calculating GDP? Now, below the circular flow of income chart, we can see that the firm sold goods to the household, and the household pays for those goods. That is, the payment is going to what? Is going back to the firm. So you cannot see how income is going and coming. That is, some people will spend, they will spend, and some will receive. That is, the amount you are spending is the amount that another person is generating as their income. Therefore, the money keep rotating, and as the money is going to the household, it's going back to the firm, then it's going back to the household, then it's going back to the firm. Now, when we now add government to it, that government is that when government collect tax, right, is an income to the government, and when government provide some when government makes some expenditure, and those expenditures they usually make is by building roads, construction, it also generates income from another person. Do you get it now? And for foreigners, that foreigners we are talking about import and export, but don't let us move to that yet. So for withdrawal and injection concepts, withdrawal and injection concept is just trying to tell us about how money is entering into the circular flow and how money is coming out of the circular flow. That is the withdrawal and injection concept. So since you have understand the circular flow of income, let's start with the withdrawal concept. Since you have understand the circular flow of income under the simple economy, that is the two sector model. So I forgot to define what circular flow of income. So in case if you need the definition. Now when we are talking about circular flow of income simply means that the flow of payments from business to what? To household in exchange for productive activities, and the flow of payments of goods and services to firm in exchange for goods produced. The goods, you know, how you want to purchase goods, you are going to pay for it, and when you provide productive activities for the firms, you are also going to receive what we call factor income, and it is calculated using the income method approach. So when you are paying for goods, is an expenditure, right? It is calculated using the expenditure method under the GDP. I hope we still remember that. We're still going to recall it in this video. Now, I said we are moving to the withdrawals concept. Now, when we talk about withdrawals, it's also known as leakages. So when you see leakages or withdrawals, they both means the same thing. Now, when we're talking about withdrawal, this simply means that money are being withdrawn, money are being leaked out or withdrawn from the circular flow of income. Now, divine it in this way. You can define it as the part of aggregate income that is not spent on goods and services. The part or portion of your income which is not spent on domestically produced goods and services. Now, these withdrawal concepts are in three forms, or you can say three types, when we are talking about the open economy. So where we have in household, firm, government and foreigner. So we have three types. But when we are talking about simple economy, where we have only household and firms, we only have one type, which is savings. So I'm going to explain each. So note that when we are talking about simple economy under withdrawal, we only have one, which is the savings. But when we now say everything together, that is household, firm, government and foreigner, that is open economy, that's when we are going to have tax and import. Import is under foreigners, while tax is under government. That's why I said for only simple economy, savings, but for open economy we have these three forms, which is savings, tax and import. Now, when we talk about saving, you know that saving is the part of your income that is not spent on goods and services. That is your income which are saved for future purpose. That's what we refer to as saving. So when you receive money, for instance, the household provide productive activities to the firm and receive factor income, right? After receiving this money, which can be wages or salary, after receiving this money, you save the money. Don't forget, when you save the money is not going back to the circular flow of income. Therefore, you have withdrawn or leaked out the money from the circular flow of income. That's why we said that saving is under the types of what? Withdrawals. Another type there is taxes. So out of your income, when you receive factor income from the firm, let's put it that way. Well, after receiving the factor income from the firm, then you pay out of the factor income, you pay tax, you paid your tax due, right? After paying the tax due, don't forget the money you paid to the government is not going back to the circular flow of income, as I explained in the two sector model. So in this case, or if we are even talking about the open economy where we have four sector model, in this case, the money has been withdrawn or leaked out of the circular flow of income. That's why it is under what? Withdrawals. And for imports now, you imported some goods. Don't forget, when you import goods, you are paying to foreigners. That money is not in your country again. It's not it cannot be calculated as part of your GDP, that is gross domestic product, because the money has gone out, is going back to foreigners. You imported goods, the money is going out of the country, it's not within the domestic surroundings. Now, what happened in this case? The money has been withdrawn from the circular flow of income because the money can't come back when you import goods. So these three are what made up what? The withdrawals. We have savings, tax and what? Import. Now let's look at the injection concept. Injection concept. For the injection, as the name implies, this simply means that money are being injected into the circular flow of income. Now, one thing you should note about this injection is that the money injected inside the circular flow of income is not originated from household consumption. That is, this household is not from the goods and services they purchase or the money they spend on goods and services that injects money into the circular flow of income. So this is what I'm trying to say. But firstly, let me give you the definition. You can put the definition in two ways, by saying that the additional spending in the circular flow of income not originated from household consumption. And the second definition is that it can be defined as the spending of as the spending of firm, government and foreigners, which increase the circular flow of income. So when we are talking about injection, these are monies that are being injected, that are coming into the circular flow of income, but we exclude household consumption. That's why I said additional spending into the circular flow of income that does not originate from what? Household consumption. but it originated from firms, consumption, government and foreigners. Now, these are what make up the types of injection. Now, let's look at the types. For firms, what do you think is going to be for firms? Firms spend their money on what? Investment. Investment. So we talk about government spending. Government spending. Let's just leave that. So the symbol is going to be G. And for the third one is going to be hey, export. Now, these three makes up what? The injection. We have investment. Firm invest. When firm did not spend their money on consumption, what they rather do is to invest their money. And when they invest their money, don't forget investment is to what? Generate income. It may not be now, but in the future. So investment is to generate income, and that income that they generate is what coming back into the circular flow of income, thereby increasing the national income. Also, government spending. When government spends, and what the government spend on? Government spend on buildings, roads, all these things that government spends, they are going to serve as income to others. Do you get the logic now? They are going to serve as income to the other. Therefore, it will increase what? The income in the circular flow. Then export. When you export goods, don't forget when you export goods, you are receiving money from foreigners. When you export goods to India, you are receiving money from foreigners. So that money you are receiving from foreigners is coming back to our circular flow. That is injected into our circular flow. Therefore, increase what? The national income. So these three are what make up injection. So we can say that injection, the letter to represent injection is what? J. We have I plus G plus X. Now, we have understand the concept of injection and that of withdrawal. Withdrawal simply means withdrawing money out of the circular flow of income, while injection, you are injecting money, but those money that you are injecting is not arising from what? The household expenditure. It's not arising from, but it's arising from all these three. So we can now explain the national income equilibrium. Now, when we talk about the national income equilibrium, the national income equilibrium, I'm coming, income equilibrium, state that the aggregate demand is equal to aggregate supply. So the national income equilibrium simply refers to the total aggregate spending. So you can put inside bracket demand. Aggregate spending is also known as demand. In an economy, is equal when the total aggregate spending rather in an economy is equal to the total aggregate output, and that output is also known as what? Supply. So in short, aggregate demand is equal to aggregate supply. So if you don't want to use the word aggregate, you can say that total. Now in this word, don't forget I said aggregate demand simply means I aggregate expenditure, and aggregate supply is what? Output. Now for aggregate demand, is the same thing as our national income. When we are calculating our national income using the expenditure approach, I said aggregate demand is what? Is the same thing as aggregate spending. So when you want to calculate the aggregate spending, the formula is the same thing as our national income when we are using the expenditure approach, which is what? C plus I plus G plus X minus N. So I hope you still remember that. Now for the aggregate supply, which is the aggregate output, is also equal to the national income when we calculate it using the income method. So the formula for the income method is that your income is made up of three things. When you have any amount with you, the amount is either you spend it on goods, that is consumption, is either you save it, or part of that income is also used to what? Pay tax. So your income is made up of three things, which is consumption, saving, and what? Tax. And this is, as we know that your income is the same thing, is equals to y, right? And is also known as aggregate output, which is the aggregate supply. Do you get my point now? So when you're talking about national income equilibrium, is when your aggregate what? Demand, which is aggregate spending, is equal to aggregate supply, which is same thing as what? Aggregate output. Now let's equate these two together. Since you have understanding, the value of this is also equals to the value of this. So equating these two together, we are going to have C plus I plus G plus X minus M is equal to C plus I plus T. Now, from this, when we collect like terms, C is going to cancel out C. When you bring this here, it's going to turn to negative. We collect like terms. So we can record that from mathematics. This is going to cancel out each other. You can try it by collecting like terms. Now, what we are going to do next is to take this M to the other side. Therefore, we are going to have I plus G plus X is equals to S plus T plus what? M. So this M have come to the right hand side from this view. So what can you notice from this? What can you deduce from this? What we can deduce from this is that when we are talking about national income accounting, it's the same thing as saying that our withdrawals is equal to our injection. Look at the formula I give for withdrawals. Whereby I say our withdrawals is what? S plus T plus M. Look at it here. And for this injection, I said I plus G plus X. Look at it here. So this simply means that our withdrawals is the same as our income when we are talking about national income equilibrium. So this is what? This is injection. So this is injection is equal to what? Withdrawal. So when we are talking about national income equilibrium, when your aggregate demand is equal to the aggregate supply, and you can say those, it simply means that injection is equal to withdrawal. That is, the money injected into the circular flow is equal to the money withdrawn from the circular flow. That is what the national income equilibrium is talking about. So now let's look at this withdrawal and injection again. So there are some things that may happen in the economy. Let's start with when our injection is greater than our withdrawal, or when our injection is less than our withdrawal, or when our injection is equal to our withdrawal. What is going to happen? So in a case whereby the injection, that is the money that is being injected into the circular national income, that is the circular flow of income, is greater than the money that is withdrawn from the circular flow of income, what do you think is going to happen? What will surely happen there is that there will be a rise in what? National income. So we say that rise in national income. So there will be a rise in national income. But when the money that is injected into the circular flow of income is less than the money that is withdrawn from the circular flow of income, there will be a fall in national income. Sorry about that. Now the last part when the money injected into the circular flow of income is the same as the money that is withdrawn from the circular flow of income, what will happen? There is just a neutral. This is just going to be what? Neutral. There is no rise, there is no fall in national income. It's just what? Neutral. And in this instance, there is going to be stability. Stability in what sense? That there is no excess demand, there is not excess supply. No excess demand, no excess supply. And what again can we see? We can say that there is not going to be tendency of rise and fall when the money injected is equal to the money withdrawn. So before we move to the multiplier, I want us to examine the national income equilibrium under simple economy. So there's something slightly different when we look at the national income equilibrium under simple economy. Don't forget I explained that the other time, because the one we looked at is open economy, where we have individual, firm, and government and what foreigners. Now let's look at simple economy. For simple economy, whereby we have only firms and what household. I said it the other time. So this is for simple economy. Simple economy. What really happens here is that when we are calculating the income in simple economy, when we are talking about consumption, starting with what? Household. In the household aspect, the income of an household is used in two ways. Don't forget when we are talking about um disposable income. So let's leave that aside. The income is used in two ways. Is either you consume the income or you save the income, right? So we have consumption plus savings. That is for household. Now for firms, if the firms does not consume that income, they spend it on what? Investment. They invest the income. So for firms, they use their money in two ways: consumption and what? Investment. While for household, we have consumption and what? Savings. Therefore, when we equate this, since both give us income, both generate income, simple economy two sector model or two sector. When you equate this, collecting like times C is definitely going to cancel C. So these two will cancel out each other. So we have what? S is equal to I, which simply means that when we are talking about the national income equilibrium under two sector model, that is simple economy, two sector, or you can say two sector economy, the saving is equal to what? Investment. So when you see saving is equal to investment, note that the condition there is that two sector what? Economy. But when we are talking about the aggregate, the total overall, that is the first sector model, the open economy, where we have individual, firm, government, and what? Foreigners, our withdrawal is equal to what? Leakages. Now the last part, which is the multiplier effect. So for the multiplier effect, I hope you can manage this multiplier effect. So for multiplier, this is also a topic on its own. It's also a topic on its own. After talking about consumption, saving, and investment, one can move to multiplier, but we can briefly talk about it here. So when we're talking about multiplier effect, this simply means the ratio of change in national income to what? Change in injection. So this is what I mean. So for the multiplier, it is represented by K. So let's just write K. Multiplier is represented by K. And this is what I mean. Change in your income, let's write Y as our income, over change in injection. But when you move further, some of the question can be on this injection. Don't forget, injection have three types: expenditure on investment, government spending or government expenditure, and export expenditure. So it depends on the question. If the question is talking about just expenditure, is talking about government expenditure. When the question is talking about investment expenditure, all this is representing what? J. Since we said J is what? Injection. We have written it here. So we know that J is injection, Y is income, and K is multiplier. So this is the multiplier formula. And we have alternative formula. The alternative formula there is that K is equals to 1 over MPS. So MPS simply means marginal propensity to save. Sometimes they call it marginal. So let me tell you the one. It is called marginal propensity to withdraw. But in that withdrawal now, we are looking at only two sector economy. That is, we are looking at the simple economy. And don't forget, for the simple economy, I said we only have savings. That's what I explained at first. That's why it is written, instead of writing marginal propensity to withdraw, you just write marginal propensity to save. Just write marginal propensity to save. You can see I've written it on the board. Multiply is equal to marginal propensity to save. And we know that marginal propensity to save plus marginal propensity to consume is equal to 1. Therefore, we can change this formula again by saying that, or 1 over 1 minus marginal propensity to consume. Do you get it now? Because when you collect like times, marginal propensity to consume is same thing as saying 1 minus marginal propensity to save. When you add these two together, it must surely give you what? 1. So this is what we use to calculate multiplier effect. And we are going to look at just an example. Now, when we are talking about the multiplier effect, I've defined it. So the logic or how the multiplier effect work. This is how multiplier effect work. If government spend money on building, construction of roads, hospitals and this will generate income for another person. That is, government expenditure is going to generate income from another person for another person. Now, when it generates income for another person, the person is also going to spend that income on consumption. When he now spend that income on consumption, it's going to generate income for another person. And that person also is going to spend the income on consumption, and after spending the income on consumption, is going to generate income for another person, and it keeps going on and on like that. That is why we call it what? Multiplier effect. So we want to know that if we inject this certain amount into the economy, how much is it going to generate as national income? That is the logic, or that is how national multiplier effect works. Do you get the logic now? Let's examine these two questions. So the first question says that we are given the MPS, that is marginal propensity to consume, solution. We are given the marginal propensity to consume, and it says in a simple economy, find the multiplier and we should interpret our results. Now, what did I say about the multiplier? I said the multiplier is what? K equal 1 over MPS, which simply means that to get our multiplier, which is K, simply means 1 over 0.2. And when you input this in your calculator, 0.2 is also known as what? 1 over 5, which simply means that the multiplier is equal to what? 5. So you can solve this collecting like terms by changing this fraction to multiplication. You are going to get 5 as your result. Now we have gotten the multiplier. It says that we should interpret our result. I said it the other time, so let me say it again. What this simply means is that for every 1 naira injected, it generates, it's going to generate how much? 5 naira. So this is the interpretation, that when we inject every 1 naira into the economy, it's going to generate 5 naira. So the 5 naira is gotten by 5 times 1. We are going, this is the multiplier effect. This multiplier effect, we are going to multiply it to the amount generated, amount injected, right? So the result is going to be what we are going to generate. as what? National income. As national income. So write as national income. So that's just the interpretation of this multiplier, and that is how multiplier works. Now let's look at this tricky question for 2. So for 2, we have that if the MPC is 0.8, calculate the multiplier. And don't forget, I said to calculate the multiplier, we know that is 1 over MPS, right? And MPS is equals to 1 minus MPC. So we can just say that the multiplier is equals to 1 minus MPC, because we are giving information on only MPC. Now we have the multiplier is equals to 1 over 1 minus MPC, that is marginal propensity to consume. From the question, we have 0.8. So when you subtract it, it's the same thing as saying 1 over 0.2. And we have solved this the other time. We got it 1 over 0.2 is what? 5. So our multiplier is 5. Now for part B, the question says by how much expenditure be increased to increase income by 10,000 naira. So there's a mistake in the sentence. But what this is trying to tell us that by how much expenditure, that we should look for the expenditure whereby there will be an increase in the income with this amount, which is 10 naira, that will lead to an increase in income. And the increase in income is what? 10,000 naira. That's how much expenditure. So how do we get that? We know that our multiplier is equal to change in income, that is increase in income over increase in injection, and that injection is also a spending, is an expenditure, either government expenditure or investment expenditure, or the last one, which is export. Do you get it now? So we can just say that our multiplier here 5 is equal to change in income. We are giving the change in income, that is the increase in income, which is 10,000, over, we are asked to look for the expenditure. So we can just say a change in expenditure. When you collect like things, this simply means that change in injection, which is for the expenditure, is equal to 10,000 over 5. So 10,000 over 5, we are going to get 20. So that is 20,000 naira. So the increase in expenditure is going to be what? 20,000 naira. So 20,000 naira increase in expenditure will lead to an 10,000 naira increase in income. That is what this is talking about. So we have solved that, and this is where we are going to stop for today. So thank you for watching. Please don't forget to like, share, and subscribe to my channel. Bye.